Did COVID remote working launch economy-wide productivity gains? Well, we get the answer to that question now from our chief equity strategist and economist, John Blank. John, did the remote working show up in the U.S. macro productivity figures, or is this more a question of public versus private company data?
The U.S. productivity figures at the macroeconomic level, Terry, for the last 5 quarters have shown productivity gains that were not available to the U.S. economy for 6 or 8 years prior to that. So I do have to attribute to the pandemic, and there was one quarter, the winter quarter, when, of course, we were all truly shut down, that it actually was somewhat negative or lower. But over the last 5 quarters, even incorporating that, it's very obvious that there was some productivity gains. What I would tell people is those productivity gains were really not just more significant in the past. In fact, they were less significant in the past, but they were a change from no productivity gains that we've seen for 6 or 8 years. So it's very likely that the services economy, the management economy, those of us in white collar jobs that can stay home, did in fact cut our commutes out and improve our productivity, and that did show up in the GDP accounts, which is actually notable and why we're doing this podcast.
So the main factors then in that productivity is just the remote working, lack of commuting. Those are the two main factors?
Well, we can debate this endlessly, and I think it should be debated, but it's truly the case that what accelerated clearly was the amount of goods production and internet delivery, along with lower commutes. So I think, being a microeconomist and going through the multiple studies of how this benefited us is probably the right answer. It's probably not a very simple answer or a clear answer. It's probably 18 or 20 different variables that all improve incrementally. And that shift was so broad because it hit so many millions of homes. That's what picked up the actual GDP account information of productivity gains.
I see. So did the latest U.S. monthly jobs number reflect a peak? And if so, then how are the unemployed folks who are still not answering help wanted postings factoring into all of this?
Well, today, Terry, we're going to get, or actually I should say next Friday, we're going to get the non-farm payroll report for August out. They're looking for a 5.2% household unemployment rate for the United States, down from 5.4% in July. Do I think that's accurate? Given what we've seen out of retail sales and consumer sentiment, I'd be surprised to see that 5.2% number. I actually think the consensus is going to be wrong here, and most of the unemployment claims numbers and all the other fundamental spending variables are telling us it's going sideways. So I think the answer to the unemployment story is once you bake out a lot of the teaching gains and a lot of the leisure and hospitality gains, which, by the way, are going to start to peter out as we enter the fall, I think this number is going to go sideways.
You wrote recently, John, about inequality within the economy. What does that mean?
Inequality is the right way to look at what's going on here, which is, do we get people who are in hourly jobs, part-time jobs, with less commitment to the labor force? Are they getting the returns out of this economy? And I think the answer is, as we talked earlier, remote working is really a full-time white-collar game. So it's actually making the inequality problem in the United States worse. So this is a policy issue, and it's probably going to not be addressed in the face of COVID until COVID's out of the way. But at some point in time, we do need to have a critical discussion about distributing the income in this economy across more cohorts of people in a more equal fashion.
Does the economic recovery, given all of the latest economic data that's come out, look a bit tired to you?
Yes and no. I mean, you got to remember this was all really driven by the return to work and the stimulus checks. So I think it's not surprising that we've seen the pullback. And I actually think it's held up quite well in the face of the Delta variant. I think the lack of shutdowns and the fact that people are getting used to putting masks in public spaces and enclosed spaces is showing up too. So I think, again, I just think we're going to go sideways at a high level now.
You and I are talking here on August the 27th. This week sees another Jackson Hole Symposium. It's a virtual event this year, But that doesn't take away from the key question of when is taper time? What is the key event there that might answer that question?
Yeah, I have the Jerome Powell comments in front of me that he just put up for Jackson Hole. And there's one paragraph I'll read to everybody that's critical. What he says is my view, his view, Jerome Powell's view, is that the substantial further progress test has been met for inflation, and there has been clear progress toward maximum employment. So he's actually of the view that taper is fine. And at the July meeting, he was of the view, as were most participants, that the economy had evolved broadly as anticipated. It could be appropriate to start reducing the pace of asset purchases this year. So this year means 2021. So he's on board, and he was in the majority with people to taper this year. Now, the only thing that was slowing down that is, and it didn't get put into the news media correctly, the next line is critical. He said, the intervening month has brought more progress in the form of a strong employment growth through July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and involving risks. So what he means here is, I would think the taper is probably more of a December, November than an October play. But it does sound like he's going to start doing it, and that's going to happen before this year is out. So that was the news today, and surprisingly, the market actually did quite well in the face of it, Terry.
So do you think that those jobs numbers that come out next week that you mentioned a while ago, are those going to be the deciding factor here?
I was putting together the Global Week Ahead today, and I decided to put the taper talk discussion above the non-farm payroll as a relevant event. And then what I mean by that is I actually think this tapering and the Fed liquidity is still driving the market regardless of what happens to that payroll number.
As the prospect of stimulus being reduced when the spread of the Delta coronavirus variant and supply chain issues still loom over a recovery that is, to some people, started to look a bit tired, has that spooked the markets?
Absolutely not. Like we just talked about, it's the Fed stimulus and the Fed money that is still on board. And even with a taper, they're still going to be pumping some monthly bond purchases and mortgage-backed purchases into this economy for months more. So I think the market is realizing when you net it out, it's still Fed liquidity just at a reduced level that's going to drive this market upward.
All right. A few SECs ranked strong buy stocks that you're following include Mercado Libre, TJX Companies, and BASF.
Yeah, let's talk about Mercado Libre. This is a fascinating company. The stock price is $1,866 a share. Unreal. So what's going on here? This is a Buenos Aires, Argentina-based company that's one of the largest e-commerce platforms in Latin America. And this is basically the Amazon company of all these Latin American companies. What's fascinating is it's got $4 billion in revenues in 2020. It's an $1,800 share price stock. I think I can tell you safely, Terry, that is a value score of F. The other ones were BASF, correct?
Yes.
BASF is a big German chemical company. And this company, just for example, is $20 a share. $20 a share. Now, Terry, I have to tell you that there's a huge gap between 1,866 and $20 this year.
Yeah.
So this is the Zacks rank number one stock, but please, people, pay attention to value. This is a value score of B. What was the third one, Terry?
TJX Companies.
Yeah, TJX. So this company is a retailer. And when you get into a company like this, you say, okay, is the retail sales really slowing a company like this down? When what you see here is this is a $74 share stock. It's actually gone up from $66 a share in July to $74 a share now. So in fact, it's not. And again, the value score is D. I don't like this one as much as BASF, but you've got to say to yourself that the number one rank for a actual in-store retailer is bullish for retailers. And the fact that people are buying this stock now tells you the market is overlooking that retail sales data.
Our chief equity strategist and economist, John Blank, looking at the economic picture for us. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.